And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Wednesday, it's hump day. It is also November the 5th as we get into this trading week. Again, the first full trading week of November. And very quickly, we're going to wind up into a holiday shortened week with Veterans Day being on Monday. And so that markets will be closed on Monday for that. And then Thanksgiving right around the corner from that. So another holiday. We got a lot of holidays coming up. This is holiday season, which means that we're going to start seeing a lot more kind of lighter trading volume potentially. This is where the inmates run the asylum. So again, we typically have a bit more volatility in the markets, but markets tend to perform okay. This is why November, December tend to be typically the stronger months of the year, just kind of as momentum carries the market more than anything else. But that's kind of what's going on. Earnings-wise, again, as we continue to kind of look at earnings, technology and energy and financials, the big winners in terms of earnings this quarter. Discretionary staples, kind of the others overall kind of lagging the index. Overall, the blended rate of earnings growth for this quarter is around 11%. So again, it's been a decent earnings growth quarter. And again, as we stated before, coming into Q3 reporting season, estimates were a little bit low. So again, it was not surprising. We had a very high beat rate for earnings. And with that, of course, we've seen about 11% earnings growth for the quarter. So again, good enough to support markets, good enough to support valuations. But again, not surprising, kind of coming into the cycle that, markets have been running really, really hard since that April sell-off. So again, over the last couple of days, we've seen a little bit of weakness in the markets and immediately, I know we haven't seen red days in a while. And so when there's some red days in the market, we start valuations, this thing, that thing, the other thing comes around. Just take a breath here. Markets are just having a bit of a pause here. Nothing really crucial about that going on. Outside of that, there is a Supreme Court ruling coming up that could affect tariffs. Right now, poly markets are only expecting about a 35% chance that the Supreme Court rules in favor of tariffs. Now, here's the potential issue. Tariffs are a tax, and taxes should be passed by Congress, and that's probably where, and this is why poly markets is kind of thinking that the Supreme Court may rule against kind of using executive power to impose tariffs on foreign countries because it is a tax, and that should be a responsibility of Congress to pass that tax. So we don't know what's going to happen yet, of course, but when the Supreme Court rules on that, if they happen to rule against tariffs, there's going to be, some potential consequences to think about. First of all, the tariff revenue may have to be refunded. We'll see what the Supreme Court says, but we may have to refund the tariff revenue collected. That could lead to lower prices for households, maybe not. Typically, once prices are established, this is kind of the thesis about inflation, higher or lower inflation. It's like, oh man, if we get inflation down, prices will come down. Prices typically stick. I mean, you'll never pay $1 for a gallon of gasoline ever again in your life, right? I mean, it's just those days are past, and once prices kind of get set, they typically don't go backwards. So even though the tariffs may get refunded, we may or may not see lower prices coming into households, but that's the expectation, right? Remove the tariff, lower prices for households. We'll see if that works out or not. The bigger question will be really for the stock and bond market. Is there any impact there? Removal of the tariffs obviously would be a boost to producers, obviously taking off that impact to their revenue. So we could very well see a lift to asset prices in areas where tariffs are the most prominent, particularly in the manufacturing production side of the economy, the producers of physical assets that are the most impacted by tariffs. Think automakers as a good example for that. Technology as well may get a boost. So again, that's coming up. That's be something worth paying attention to. All right, with that said, let's get into what you need to know before the bell this morning. A couple of interesting things over the last couple of days. Again, markets had a fairly significant run going into kind of this week. So again, this was kind of a big week for earnings last week with Microsoft, Apple, Amazon, Meta, Palantir on Monday. And what we've seen here in terms of earnings season so far is that beats are not being really well rewarded, but that's only because a lot of these stocks have had huge runs going into their earnings announcements. So their Palantir's earnings announcements were great, right? But the stock had already run so much, it was at an all-time high. Not surprising, it was kind of a bit of buy the rumor, sell the news. We saw the same thing with Meta. We've seen the same thing with a lot of other companies. I think we'll probably see the same thing with NVIDIA. NVIDIA's been on a huge tear as of late. Not surprising to see a little bit of a buy the rumor, sell the news when they report earnings later this month. But overall, despite that, right, and we've had a lot of headline concerns about, people are starting to wake up to valuations. Ladies and gentlemen, all we've done so far is pull back to the 20-day moving average. This is the running trend line for the markets going all the way back to, really the kind of the April lows where we were coming out of that. And this running 20-day moving average has been a very, very good trend line. Buyers continually show up at that 20-day moving average to buy stocks. Most importantly, the 50-day has been acting as really, really strong support. Those are trending very close together. Now, importantly, moving averages are trending positively. That means that, again, what is a moving average? A moving average is just the average price over the last specified period. So 20 days, 50 days, 100 days, 200 days, whatever. So if prices are consistently rising over time, you're going to get an upward sloping moving average, which is supportive of the bull market trend, right? Because you want continually rising prices. So all these moving averages are sloping positively right now. That gives the bull market support, a good bit of support here. And again, there's lots of levels of very important support right below current prices. Again, we got the 20-day that we're sitting on right now. We're going to challenge that a little bit this morning. NASDAQ's looking to be off about 93 points. The S&P is going to be off about 25 points this morning. Nothing big. But we're going to see a little bit of a challenge of that 20-day moving average. So it'll be important to see buyers show up today. We saw buyers show up yesterday. Markets were down pretty sharply in the morning. We did see, even though the market ended negatively for today, we did see some buying step into the markets yesterday. So there are buyers there right around this 20-day moving average. The momentum signal is close to a sell signal. That could keep some pressure on markets here over the next week or so, but we are working off some of that overbought condition we had kind of coming into this week. Again, we had this market pushing to all-time highs. So again, not surprising here, we're getting a little bit of a pullback. This is not something to be overly concerned about right now. But again, as we've talked about before, manage your risk, take profits, rebalance, those type of things. If the decline in your portfolio, and by the way, this is a little bit of kind of a phase here for the markets. And it's also a little bit different than what's happening in a lot of people's portfolios. If you've got a portfolio that was heavily leveraged into very high beta stocks, your performance is a lot worse than the markets right now. So again, that's why look at your portfolio, look at your performance relative to the markets, make some adjustments. If this sell-off for the last couple of days has been more than painful for you, you've got too much risk in your portfolio. Think about rebalancing a little bit. Yesterday, companies like Berkshire Hathaway, Costco, Walmart, those stocks were doing much better yesterday versus the overall market. So again, having a little bit of defense in your portfolio will certainly help mitigate some of this downside volatility when it occurs. Anyway, that's what you need to know before the bell this morning. We're going to come back, pick up with Danny Ratliff right after the break. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome to the show this morning. It is, of course, Wednesday. That means Danny Ratliff is here. And We're going to talk a little bit about RMDs. It's that time of the year, ladies and gentlemen, where it's time to start making some financial decisions for wrapping up this year. There's a lot of things you need to start thinking about between now and the end of the year. There's some things you need to get done tax-wise for the end of the year tax filings. Of course, as we wrap up 2025, April's right around the corner. You're going to be filing your taxes for 2025. So this is an important time of year to start thinking about things like tax loss selling, tax loss harvesting, those type of things in your portfolio to help mitigate some of your taxes. And particularly in a year like we've had this year where you've got a lot of unrealized gains, or potentially you've got some realized gains to because it's been a good year for stocks, is don't forget about that tax bill that's coming up right around the corner. So again, as that occurs, this is a good time. Look at that portfolio and start looking at things that haven't performed well for you this year. Just because you sell something, I don't know why people think this. They go, oh, if I sell this stock, I am never allowed to buy it again. The Wall Street minions will say no, right? If I try to buy it back, Fidelity says, no, can't buy it. You sold it, you're out, you're done. You're excluded from the Palantir Club, whatever it is. That's not the way markets work. There's nothing wrong with selling a stock at a loss. We have psychological biases against that because we feel like we're a loser if we sell stocks at a loss, right? We don't want to be thought of as a loser, that, oh, I can't believe you bought that stock and lost money on it. Not everything makes money in the markets, but this is a really good time of the year to look at your portfolio and say, that stock has not performed well in my portfolio. I'm going to sell it. I'm going to take the loss on it. But I love the company. I just bought it wrong. That's all that happened, right? Great company. You buy a great company. You just buy it at the wrong price. It happens. It happens to everybody throughout history, and it's just something that you learn to deal with. Be unemotional about your positioning. Sell it, take the loss. In 31 days, you can buy that stock back if it's still something you want to own, right? And so don't get wrapped up in the red on your balance sheet, but this is a good time of the year to look at those reds and say, look, I've got a lot of green on my balance sheet. Maybe I should take some profits in some of my big winners. Let's bank some of that cash, sell some of my losers, and offset my taxes so that I can mitigate, I can rebalance my portfolio, but mitigate my tax impact from doing that. And this is something that people overlook on a regular basis, and it actually winds up costing them money over time. So don't forget about the importance over the next month or so of doing some tax loss harvesting and doing that. Now, from the other financial planning side, there's also some other stuff you need to do. Danny, good morning.
Hey, good morning.
It is that time of year. We have to start. And do your advisor a favor, please. Do not wait until December the 28th to go, I need to make an RMD. Yeah, just call your advisor now and start working through this stuff. Everybody waits until the last minute, and you run the risk that something gets messed up, something gets lost in the mail, whatever, and it doesn't get done in time. It's just not worth that risk. Just there's some things you need to be working on, and don't postpone until the last minute to try to get some of these things done. Right, Danny?
No, absolutely. And I think that many times that we're seeing a lot of custodians are taking longer and longer to process things, especially when we get down to the wire. And so it could be a challenge to actually get things through. So make sure you're talking to your advisor now. Historically, it's not been that big of an issue, but as we've seen a lot of consolidation amongst firms, and just a whole lot of work in that service side, be cognizant of that. And, inevitably, we understand you're going to have somebody who says, hey, we don't want to do a Roth conversion. And December 31st, they're going to say, oh, you know what? I calculated my numbers wrong. I'd like to do one. That's okay. Just be aware that some of these firms are now kind of indicating that if we don't get things done sooner rather than later, they cannot guarantee it to be processed. But so the things you were just talking about, Lance, I think are extremely important. We're talking about how do you save money today? What does that look like? But some of the bigger picture items is this is always that time of year. We want that checklist. What are we looking to do to accomplish to make sure we're taking advantage of all the tax, I'm not going to call them loopholes, but advantages that we can currently do. And then also, we need to start thinking about how do we plan out into the future? And unfortunately, most people that starts in, say, January for them. And for many people, that dies in February, just like most New Year's resolutions. But I think making a plan and having an idea as far as what you should do is extremely important. And so as Lance was just talking about RMDs, we are in that time of year. And one thing we do need to realize is that RMDs have changed. So Secure Act 2.0's moved them from 70.5 to 73. By 2033, that RMD age, the required minimum distribution age of when you are required to take a distribution from your 401k or IRAs, is going to go up to 75. But I think there's a couple things that we can be doing now and kind of start to really think of things that you can take advantage of to potentially reduce that, because the problem is we see so many people that retire and the bulk of their assets are in those retirement funds. And they don't think about all the kind of inherent problems that it can create when Uncle Sam knocks on your door and says, hey, you've got to start taking these distributions. And you may have other sources of income. And now you begin to get into some other areas where additional taxation begins to occur. And so one thing, as we're talking about RMDs, how can we reduce those? And what can you be doing leading up to age 73 right now to kind of start to mitigate or soften that blow as far as what the amount is that you must take out? And one thing, and probably the most commonly used tool, would be a Roth conversion. And that's something that we talk about frequently. I know you guys are probably tired of hearing us talk about it, but I do think it's something that can be meaningful if you use it properly. And so keep in mind, this is a great way, especially if you retired early and you said, you know what, I've got some income coming in, but it's not nearly as much as what it was when I was working. Go ahead and start looking at those Roth conversions. Stay within specific tax brackets, maximize those tax brackets, and be cognizant of those Medicare premiums, that IRMA charge that could begin to hit you. So keep in mind, they do a 2-year look back. There's many cases we can make a very strong case to say, hey, go ahead and pay a little bit of IRMA. Let's go ahead and be a little bit more aggressive on this conversion. And, right now we've got a little bit of a bandwidth here. We're not under the threat of taxes reverting back to the old tax code. So, where I think a lot of people's back were against the wall and people were very aggressively trying to convert, now we've got a little bit longer runway here. Now that can change though. As the pendulum swings and we may get a different administration and the government continues to spend money, they're going to potentially raise taxes at some point. So while we have this tax code now, use it to your advantage for maybe 5, 10, 15 years down the road where it may not be the same. Another one that people can look at is, if you are retired, I can't even speak right. Retired. Go ahead and start tapping that IRA first. The common, conventional wisdom would suggest, hey, most people will tell you, burn down all of your other assets first. Keep that because it's going to grow tax deferred. But that's still going to leave you with that big RMD bill. And if you want to use these funds as a legacy asset, Secure Act 2.0 has also now made it that non-spousal beneficiaries are going to have to take distributions, and the account is going to have to be fully liquidated by year 10. So you may want to begin to flip the switch on and say, you know what, let's do a combination of the two, or just do one. And hey, let's draw down that traditional IRA. Be mindful of those brackets again. Another one is if you are still working, so kind of the opposite, what we just talked about, would be Roth 401ks. And depending on your income, we can make arguments both ways that maybe you should go ahead and put these funds aside. The beauty of that Roth 401k is that you're going to be able to contribute quite a bit more than what you can contribute into an IRA. And one big misconception that we hear often is that I make too much money to contribute to a Roth 401k. Well, there are income limitations on a Roth IRA, but not on that Roth 401k. And more firms are offering that within their 401k plans. So don't think that because you're a high income earner that you cannot make those contributions. So give you an example. You can contribute $7,000 into a regular IRA. If you're over 50, you can contribute an additional $1,000 into that Roth 401k. Now, keep in mind, they're going to aggregate your traditional contributions and your Roth, but you can contribute up to $23,500. If you're over 50, you get an additional $7,500 catch-up. And there's that super catch-up that just came out here recently, which will allow you, if you're between 60 and 63, to contribute an additional $11,250. So if you're over 50, you can contribute up to $31,000. However, if you're between 60 and 63, that's $34,750. That's quite a bit of money and a lot more than what you can do into a traditional, just regular IRA. So remember, no income limitations. You're not going to be subject to RMDs in those Roth accounts. So there's a lot of beauty in that. That's a way that you can have a little bit more control of your assets versus the government telling you, hey, you got to take X amount this year. And every year that number gets bigger. So those are some easy ways and just things to think about. Another one that I'm finding more and more people asking about, or we're bringing it to their attention and that they just didn't know, is a qualified charitable distribution. So you may see the term QCD. That is exactly what it stands for. And this is essentially where you're making charitable contributions directly from your account. Now, you have to be 70 and a half. So this is a little bit of a funky number in the sense that they never moved that up when RMD age changed. So now RMD is 73, but at 70 and a half, you can begin to utilize a qualified charitable distribution. So if you're tithing to your church, if you're giving to any charities, this is a great way to just pay it directly from your IRA and get that right off the books. And you're not going to be taxed on those funds at all. So you can do up to $108,000 each year that is going to be indexed for inflation. So another great tool, I think something that should be utilized. Another one would be a QLAC, so Qualified Longevity Annuity Contract. Now, this is a little bit trickier. So the idea behind this is that you actually purchase a deferred annuity in your 401k and your IRA and retirement assets. And what it does is it allows you to defer those RMDs. So keep in mind, it's deferral. It is not meaning that you're not going to be subject to them at some point. The beauty of this can kind of be used for, what I would consider more longevity planning. Say, okay, we can move these assets. Now, you can only put $210,000 into this type of contract. However, you're not going to pay RMDs in the interim. So you must start beginning distributions or payments by age 85. So it gives you a bit of flexibility in the sense that, okay, we can look at longevity. You can also have your spouse on it, so you can do a joint contract where they'll pay over both of your lifetime. And this is a way to shelter a portion of assets, potentially draw down on other assets and say, okay, you can stage these assets for longer term. This doesn't work for everybody. We run planning and scenarios for a lot of different people. And we look at this and many times it's just said, well, this isn't probably the best idea for you. However, there are times that this can be a really good idea. And so when we're thinking about just trying to think outside the box, think about all the different ways, and really what you need is to have that plan. But as we are seeing the working force population in many ways, we have a lot of clients that are still working. I mean, Lance, how many people do you know that are, they've retired, they've gone back to work, they've done contract, or, there's plenty of them. And so there's that still working RMD deferral. Now, here's the caveats. What that means is if you're still working, you're at RMD age, so 73 or older, and you can contribute to your 401k plan. You can still contribute, which is great, but you're not required to take those RMDs. Now, keep in mind, this is only for a current plan that you're contributing to. So if you're not contributing, or if you have assets outside of that current company plan, you're still going to be subject to RMDs from that. But the assets in that 401k, you're not. So there's a lot of beauty to that as well. And so these are ideas as we're getting towards the end of the year. You're thinking of ways that you can, save a little bit of money, but more importantly, planning for the future. I feel like, especially if we talk to most CPAs, they're looking and unfairly, we grade them on how much money do you save me today. This is looking at future returns, future taxes, future legacy planning. So a lot of these different kind of agenda items need to be implemented and focused on here. And I think that if you have a sound financial plan, you should be having some of these discussions on what is the proper way for these distributions for you to continue to accumulate, and how do you keep, at the end of the day, all this is about is how do you keep as much money in your pocket and your family's and out of Uncle Sam's legally, technically.
Yeah. And, just importantly too, just if you're contributing to your 401k plan at work, just don't forget to figure out how much you've contributed so far. This year, correct me if I'm wrong, Danny, it's $23,500 for under the age
50,
and then over the age of 50 it's $31,000. So if you haven't contributed enough, you can kind of catch up here at the end of the year and get your contributions maximized to your 401k plan as well. I mean, that's just for me, how you go about doing it is up to you. But whether you've got a tax deferred plan or a Roth 401k, as Danny was talking, not everybody has access to a Roth 401k. But if you have one, they're a really great option. But taking advantage of those are either type of plan is certainly good. You were going to reduce taxes either on the front or the back end. So it's just a question of where you get the tax deduction from.
Yeah, and that's a great point. And so understanding where you've been and where you are and kind of what kind of type of bandwidth you have. But importantly, so you're going into the new year as well. Have a really clear understanding as far as how your 401k or your employer is contributing to your plan, like that employer match. Most traditionally it's going to be, okay, if you contribute 3%, we're going to match up to 100%, or maybe if it's 6%, we'll do 50%. There's all different types of contributions that they can do. But there are times, and there's some plans that I've seen that'll say, okay, we're going to give you this match, and then every paycheck, we're going to give you $250 or $500. So there's additional ways for you to collect those funds. And, one problem I've seen with a handful of people in the past is that they go ahead and they say, you know what, I'm going to max out the 401k immediately. Well, in an environment where they're going to give you that additional little bump where it's more of a set amount.
You don't want to miss your match.
You miss, you're not missing, so quote unquote, that match, but what you're missing is that additional bump that they're going to give you, that set amount. Yeah. And so make sure you have a really clear understanding as far as how they make those contributions for you.
So, one thing that was kind of a bigger deal a while back, and I don't know if it still is, but is doing, kind of backdoor conversions where you over contribute to a 401k plan, then immediately roll that money out into a Roth IRA. Is that still viable here in 2025?
It is, but more so what Lance is talking about is, so the backdoor Roth conversion essentially is what it is. So essentially you put money, it's a non-deductible contribution into a traditional IRA, so it's got to be non-deductible, but then you will convert those funds directly into that Roth. And, the issue is that many people have other traditional IRA assets out there, and so they have what they call the pro rata rule. And so depending on how much money you already have in a traditional IRA, it can work against you in the sense that you think you're making this non-deductible contribution, which you are, but then on the back end of it, they actually tax a portion of that as you're converting from that traditional IRA to the Roth. So keep in mind, if you do have other traditional IRA assets, this can work against you in some ways, and know those numbers so you don't get caught off sides and you get a tax and you're like, oh my goodness, what just happened here? So it's a great way to utilize and get funds into a Roth IRA if you're above that income limit, but just be very, very careful with it.
Yeah. I got a question in chat just asking about, how much tax are you saving with a 401k locked into a plan? So, you're saving, it depends, kind of how you're contributing. If you're contributing to a pre-tax 401k plan, you're not paying any income tax on your earnings. So if you earn $100,000, the first $23,000 that goes into your 401k plan, you're not paying any tax on, right? So you reduce your taxable income immediately to 76.5, sorry. I get my math right this morning. It's too early for math. But you're reducing your taxable income up front, and so you're not paying that tax today. Now, you're going to pay tax on the money when you pull it out of that 401k plan. When you retire, you'll pay tax on the income that you pull out. If you do a Roth 401k, you're paying all the taxes today, so you're not getting any tax benefit today, but you're not paying any taxes on those withdrawals in the future. And so if that income has grown dramatically in your Roth 401k by the time you retire, it's going to be your benefit. So it is a complicated question about how much you're saving, but it depends on the question of when am I going to save those taxes. But you are going to save taxes in one form or the other. You are going to reduce your tax liability.
Well, and I think the main thing here is that for so long we've all been told that we're going to retire in a lower tax bracket.
No, that's not the goal.
No, but that's what you've been told your whole life is that, you go ahead and you max out the pre-tax, go ahead and put these funds in, and so that way you're not paying taxes now, you're going to pay taxes later, and that you're going to retire in a much lower tax bracket. Well, that's not always the case, because what most people forget to factor in is all of these contributions they made. Number one, they're not taxable. So let's say you make $100,000. Well, now your income's actually $76,500. Well, okay, what are you actually living on? And are you saving money? So where are you? So most people say, well, if I'm making 100, I have to have 100 in retirement. Well, that's not always the case. But what we do find is that taxable income is historically very, very similar. And sometimes, especially in the early years of retirement, people are checking off bucket list items. They're saying, hey, I want to make that trip overseas. I want to travel. I want to go do this. And so you're spending a little bit more money, initially, and it's kind of a goofy way to say it or look at it, but we call it the retirement smile, where initially you retire, your income is going to be up here, and it begins to decline over time. Hey, I'm not traveling as much. We're aging. We want to stay close to home, grandkids. And then inevitably it begins to go back up as healthcare expenses begin to increase as we age. And so we have to factor that in. And I think that's a difficult, most people are really good with spreadsheets and pulling things up, saying, here's exactly what it's going to be. But, a lot of times we're looking at a static model where we've got to think about what does that really look like? And so talk about the qualitative aspect of it. And then that quantitative aspect will follow it. The money follows what you want to do. And so you need to have a good understanding as far as what that looks like and then long term. But that is a great question. So those pre-tax funds, you're not paying taxes now, but you will later. And then you're subject to all those other issues in the sense that you're going to be subject to those required minimum distributions. You're going to be subject to, if you pass and funds go to the kids, they're going to have to take them out within a specific time frame, that 10-year period. And so that is where I think that, we're not as focused on the long term. And so you've worked really hard. And most people plan really well to get to retirement, but then they fail to consider what are the implications on where these funds are and what types of accounts are registered in the future. Is it going to increase Social Security taxation? Is it going to cause those Medicare premiums to go up? And they can go up quite a bit. So those are things that need to be considered. And then also, if you want to use an asset with legacy intent, you want to think about, well, okay, if I pass, where are my kids? What type of money are they making? And, we won't know exactly where that is in the future, but there can be a pretty good argument that it's better to get these funds to them tax-free, because we used to be able to do something called a stretch IRA, and essentially, non-spousal beneficiaries would be able to take distributions over their lifespan. So looking at life expectancy tables, that's not the case anymore. And so those stretch IRAs are gone, where you could have those funds last for a whole nother generation. Now you've got to start thinking a little bit differently.
Yeah. And look, my wife and I are doing all of our financial planning now. I mean, we're working very hard at it. And the goal is to just leave our kids with the cost of a casket. So that's all. Everything else will be paid for. They'll just have to pay for the casket.
You'll have that paid for too.
No, I can't leave them with something, right? The whole goal is to leave them with nothing and us just spend it. So because they're completely convinced that they're set up for life after my wife and I go. But surprise, 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 as Gomer Pyle used to say. That's the goal.
Well, I'm sure Rich and I will cover the headstone. We'll make sure you have your charts on there.
Exactly.
Everything else.
Yeah.
So you're not, tossing and turning in your grave.
Don't worry about that. We've got it all taken care of. So, so anyway, but yeah, I mean, look, the important lesson here, or the thing that we're trying to get across this morning, is there's a lot of stuff that you can do between now and year end, whether it's tax loss harvesting, whether it's getting your RMDs done. And a good question we had in chat, Danny, is why not take your RMD at the beginning of the year, right?
Well, you can.
Right. It doesn't matter when you take your RMD. I'm just saying a lot of people forget about it, and then it's a big rush right at the end of the year to get that RMD done so they don't get the tax penalty for not doing it. So again, just it doesn't matter when you take your RMD, you just have to take it.
Yeah, and you can take it at any point during the year. A lot of people want to time it exactly, at the top of the market, and I get it. But you're still going to be subject to whatever that December 31st balance is. So what they do is they look back. So your 2025 RMD was based on what your balance was on December 31st, 2024. So you're going to have to still take a specific amount. And now, if you're not using the funds, a lot of people may take those funds and put it in a joint account, a taxable account, or an individual account. And then they just reinvest the funds. A conversion is kind of the opposite. A lot of people want to wait and say, okay, I want to hit the bottom of the market, which is a challenge because nobody wants to do anything at the bottom of the market anyways.
Correct.
But hit the bottom of the market and take an asset that you have a high conviction in and move those funds specifically from that traditional to a Roth and say, okay, I want that growth to come back inside that Roth account so now that it's tax-free. Right. And so there's a lot of ways to look at it and to do this, but you're right. There's, when we're looking at IRAs in general or just tax planning at the end of the year, I mean, we're going to have a lot more things to get into. This is just one topic that I think, something to think about.
Right. Well, and again, we talked a lot last year about this time about setting up, charitable donations and those type of things.
Donor advised funds, private charitable foundations.
Yeah. And those take time to set up. So if you're in the tax bracket where you're doing a donor advised fund or making charitable, actually contributing stock to your church or whatever you want to do as a charitable donation, that's fine. It just takes time to do. So don't wait until if you're inclined to do something like that, don't wait until the last minute to try to get that done, because there's paperwork that's got to get done, everything else. So just that's something you need to start talking to your advisor about now. Does it make sense for you? Does it work within your tax bracket this year? Is it going to help you or not? Figure those things out now, and then give yourself time to execute on that plan if you need to.
Yeah, and I want to make something real clear. So that qualified charitable distribution we were talking about earlier is much different, right? Mm-hmm. So qualified charitable distributions, funds coming out of the IRA, where a donor advised fund or a private charitable foundation or donations to a specific charity are going to be a lot more lucrative for you from a tax perspective, are those after-tax funds. So we utilize those in a lot of times where somebody may have a concentrated position in a stock. They want to get that off their books. And we could talk about this a little bit more detail next week, and I'm going to have a lot of details for you guys. But that's a great
Can't wait.
tool to use. Yeah, I know. Shut it. and another caveat could be is maybe you had a really good year. You got a deferred compensation, payout, or you sold or liquidated a business or, another investment. This can be a way to mitigate some taxes. And so the idea behind it, especially like a donor advised fund or any of those for that matter, could be, hey, the beauty of it is you don't have to you can put the funds aside, get the tax break this year, but you don't have to donate them all in one specific year. So we see what people call bundling, where they may say, you know what, I'm going to move $100,000 over here and I'm going to get the tax break for this year, but I'm only going to donate, $10,000 to the church or to the charity each year for the next 10 years. And so you have some flexibility with it, but you get that tax break in this year. Now, the bad part is you're not getting tax breaks in subsequent years.
Right.
But you may not need it. Maybe your income's diminished quite a bit.
Yeah, you have a year where you have like a really big bonus.
Yeah.
Right, as you're trying to shelter, or maybe you maybe you own a business and you sell some company stock, and so you have a big windfall for 1 year. That can make a lot of sense. And again, don't, we had a comment in Chaz, like, I worked all my life, it'd be hard for me to give to a charity. I understand that, right? You do work hard for your money. It's my money. It's, I've done this. And what we're talking about, though, is you have a choice to make, which is you can either give it to the government and let them spend it how they want to spend it, or you can give money to a charity of your choice that follows the principles, the beliefs, the ideas, the things that you're passionate about, whether it's rescuing dogs and cats or whatever, right? You can give money to that charity and at least know that your money's being spent on a worthy cause versus how the government spends your money, right? So that's the decision. I mean, I certainly agree with your view. It's hard to, you've worked hard for this money, you've done everything, you've done everything right, and then you're just giving money to other people, right? So it doesn't really make a lot of sense. But you do have a choice about how you're going to pay taxes regardless, right? So at least you have a choice of how the dollars you're spending in tax, whether you donate it or give it to the government, is being spent.
Yeah, I mean, Lance doesn't even want to give it to the kids. So
exactly. My kids are broke. My daughter just called me yesterday. She had been at the library at Baylor from 9 a.m. in the morning till 9 at night. So she sent me this 2-minute video this morning on text with her walking back from the library.
Yeah.
She's like, I've been here for 12 hours studying for my chem exam. And I'm like, well, welcome to adulthood. This is part of the deal, and I'm trying to explain to her that nothing in life that's easy is worth doing.
Yeah.
Right? It's you've got to put the time in. If it's worth doing, it's worth doing well.
Yep.
But she's like, well, I'm going back to my room to eat ice soup because that's all I can afford right now. So I'm like, that's part of the challenge. You got to figure it out.
Yeah. Well, at least it was like the real library. All these college campuses are now coming up with like bars that are called the library or the office or
she was actually at the library. So she's got a whole whiteboard in her dorm room that she's writing all of her chem on. So she's
I wonder where she gets that from.
I don't know where. I have no idea. But she's a sweet girl, but she's working hard for it right now.
Well, that's awesome. It'll mean a whole lot more.
Oh yeah, when she actually gets there. So any kind of closing comments this morning?
No, I think that, in general, like you'd mentioned, number one, get your RMDs done. I mean, we're already If you're a client of ours, you've been pestered already. I don't think we have that many to finish up before the year end, but certainly something that we want to make sure gets addressed. We want to do it right. We want to make sure that withholdings are done properly. So make sure you're communicating clearly to your advisor and go ahead and get that off the books. That way you don't have to worry about it. Go into the holidays with kind of all that stuff behind you. But do think about the different options and things that you can do from a contribution perspective, from a distribution perspective. And, I know I sound, and you guys are probably tired of hearing me talk about financial planning. I know Lance is. However, it is imperative, if you have a good financial plan, we're not talking about 1 year. We're not talking about, what's already happened. We're talking about what can we do in the future to reduce and mitigate those taxes. And inevitably, so instead of you, like Lance said, well, you can give to a charity, you can give to Uncle Sam. Well, let's keep that money in your pocket and then your family's pocket. You've worked hard for this. And so we talk about this often that, people plan or they save, but they don't plan on where they're saving. They don't plan on what that distribution looks like in the future. So, don't think you're always going to retire in that lower tax bracket, and don't think you have control over these taxes either. We've got a great benefit here. So if you are inclined to do a conversion, I would consider it over the next couple of years, because who knows what happens in 3, 4, 5 years. It could certainly change. So just keep those things in mind. Go into the end of the year with a good checklist, and then we're going to be giving you a lot more data and details here coming. And if you have anything you want to talk about specifically, go put it in the chat. Go to realinvestmentadvice.com, ask a question. We'll be happy to go in a little bit more detail.
Yeah, and I mean, if y'all would be interested in having us have a charitable expert on the show, we can certainly do that. Just let us know in the chat, or again, send us an email if that's something that you think would be beneficial. I mean, look, you don't need to worry about old age. It doesn't last that long. So it's just, these things that we're talking about are, kind of short windows that you've got to deal with, because at the end of the day, death is the number one killer in the world. So
yes, it is.
All right, that wraps up the show for today. Thank y'all so much. And we'll be back tomorrow with Michael Lebowitz. I promise tomorrow we will have a show with Michael Lebowitz. Last Thursday, we had a technical malfunction, which is code for Brent screwed something up in the studio, and we weren't able to have a show with Mike. So we will play catch up tomorrow with Michael Lebowitz here on the show. So we'll see you then. Be sure to like and subscribe to the channel. It certainly helps us a whole lot. We really do appreciate it. And get by the website. Our latest blog posts are out. Michael's article is out today on NVIDIA valuations and circular financing. That's on the website now, realinvestmentadvice.com. Have a great day.